Currency risk, also referred to as foreign exchange or FX risk, is related to the impact of changes in currency values on foreign investments. All investments into assets denominated in a foreign currency are exposed to currency risks. Even investing in a domestic business carries a currency risk if they operate internationally. For example, with the FTSE 100, which is an index that tracks the 100 largest publicly traded UK companies, around 71% of revenues come from outside the UK, so the index carries a substantial currency risk. The currency risk can cause the return on foreign investments to increase or decrease. If a foreign currency loses value in relation to your domestic currency, then you lose money on your foreign investment. And if a foreign currency gains value, then you gain value on your foreign investment. That is quite abstract, so I will demonstrate with a straightforward example. So I'm a UK investor wanting to invest in a US company. The current exchange rate of Great British pounds to US dollars is 1.5. So for every £1, I get $1.50. I want to invest £1,000 into the US company. So my share broker converts my £1,000 into $1,500 and buys $1,500 worth of the company's stock. A year later, I want to sell, and the company that I invested in, its share price hasn't moved. It has stayed flat all year. But the dollar has lost value against the pound, or in other words, the pound has gained value on the dollar. And the GBP to USD exchange rate is now 1.8, a 20% increase. I still have $1,500 of the company's stock as the share price has stayed the same, so my broker sells and gets this, but when converting the $1,500 back to pounds, it goes to £833.33. A 16.7% loss from the £1,000 I started with. When making foreign investment, it is important to hit the like button for the YouTube algorithm, and it is also important to assess the macro environment of the countries that may impact currency movements. It's good to look at the strength of the country's economy. Simply put, a stronger economy generally means a stronger currency, so its value will trend upwards, and the opposite applies to a weaker economy. It can also be useful to look at a country's inflation and debt levels. If a country is carrying a high amount of debt to GDP, this can be a precursor to increasing inflation, which commonly causes currency values to decline. Once assessing the macro situation, you then invest accordingly. A good example to demonstrate this process is one of my previous investments. In 2020, due to a weakened economy from the pandemic, lockdowns, and Brexit uncertainty, I evaluated that the British pound was likely to be at its lowest point. I expected that from 2021 onwards, when there is certainty around the future concerning Brexit, the economy will start to recover, causing the pound to gain in value. This would mean that all foreign investments would lose value, so I would only invest in foreign companies that I believed had the potential for a considerable amount of growth. As if I just invest in companies that do the average of 7% yearly return, this return would likely be wiped out by the currency impact, as there's a big currency risk. One particular company that fit this criteria was Microsoft, which I invested £500 into last year, when the exchange rate was around $1.23 for every pound. That has now increased approximately 13% to $1.39 for every pound. This has hit my investment return by 11.4%. Luckily, Microsoft shares have increased in value by 33.5% during the same time, leaving me with a current return of 22%. So you can see here that if Microsoft had just done the yearly 7% gain, I would be down over 4% currently. So it was fortunate of me to get Microsoft at such a low price a year ago. Comment down below what foreign stocks you invest in or are interested in. And that wraps up the video, guys. Hopefully that all makes sense and I've explained currency risk well. Have a good day and good luck with your foreign investments.